Well, good morning, everyone. Thomas Montgomery, IIMFL and Smart Money Alliance. We're excited to visit with you this Friday morning, February 19th, 2021. We get together with our distribution partners most weekdays at this time, just a little bit before 8 o'clock Central, to talk strategies, techniques, share success stories, and support you, our distribution partners. There are multiple different types of distribution partners, but we're going to keep it simple. We're going to have just rubber where the rubber hits the road today, and we're going to follow the money. It is very important that each of us have a clear understanding of how to follow the money. And we're going to look at it from two different perspectives. We're going to first look at it from the client proposition. If you can assimilate these key talking points, you should be successful. I see Jim's online. We had a number of you that are typically producing 20 or more deals a week. And then there's some of you that seem to be scraping along. So I talked to a number of our top producers and have assimilated some key talking points for you, the rest of you to follow. So let's go through this and then we'll have some dialogue on it. So we're talking about the Access to Capital program today, and that's something that you can represent as an affiliate, free and easy to be an affiliate. Who wouldn't want to be an affiliate? But really here we're talking about looking at the comp model of our joint venture partners. But regardless, we're talking about the Access to Capital program. So on the topic of following the money, let's start with what's in it for the client, right? What is the value proposition to the client? What are some talking points? How are the top producers producing? Well, they've simplified it down to a few key talking points. They tend to say the least amount necessary to move them to the next step. And they know that they're not responsible for closing anyone, are they? All they do is they submit leads in on their landing page. Not to suggest that that's not infinitely valuable and there's not skill. I'm not minimizing that. But you want to do as little as possible work. You want to say as few as possible words to move people to the next step. Don't overcomplicate it. Okay, so what are the key talking points that the top producers tell me that they're telling their prospects? They start with a guaranteed $100,000, and that's the minimum, not a maximum. Our 501c3 nonprofit guarantees you in writing at least a $100,000 capital raise. That's not the maximum, that's the minimum. The second thing they like to hit home with their prospects is there's no upfront cost to enroll in the Access to Capital program. No upfront cost. So let's pause there for a second. That's a pretty damn strong proposition even before we get to the other bullets, isn't it? If you're interfacing with small business owners, whether they be pre-launch, startup, or existing, nearly every small business owner wants and needs more capital. And secondly, $100,000 makes sure that they're not wasting their time. They know contractually we're guaranteed to help them get at least 6 digits. That's not the maximum, that's the minimum. And you're able to cast a very wide net because there's no upfront cost to enroll in the Access to Capital program. Now, you could debate, you could argue, should this be the first bullet and this is the second? But based upon the informal survey that I did with many of you over the past 48 hours, these are the talking points in the order that the top producers are presenting them. Then what you have in mind now is you have the prospect, you've got them on the line, right? They hear the money. They hear there's no upfront cost to enroll, so that reduces their concern a little bit. Now they're thinking, oh shit, man, I don't qualify. My credit's not so good, or I'm a startup business. So then the third bullet our top producers are sharing with them is, hey, just so you know, there is no minimum credit score, no minimum time in business necessary to qualify to enroll in the program. And now they're really, their ears are open. And then the fourth and final bullet from the proposition perspective is, and by the way, we'll get your first round, what we call first tranche financing, within the first 30 days. And we have guaranteed approval on the FTF. And so I could give you examples, and I thought about giving you some more examples today about some of the clients that we're getting funded with FTF. People that have credit scores in the low 600s, people that have credit scores in the 500s, people that have credit scores in the 400s, people that have high credit card utilization, people that have over 100% revolving utilization, still getting approved 100% of the time for FTF. That's amazing. That's amazing. We're on track to do over $1 million of FTF financing this month in February. So those are the 4 bullet points that the top producers are telling me that they're using when sharing the proposition. Now, some of them are doing Facebook ads, some of them are doing Craigslist ads. There's a variety of different ways that they're getting the word out there, and that's not what the lesson today is about. But it's just giving you clarity of the key points and reassuring or emphasizing you want to say as little as necessary to help people move to the next step in the process. And it's not your job to close anyone on anything, regardless if you're an affiliate or a joint venture partner. So obviously everyone has different scripting. And so as I talked to several of you that are the top producers, I did some paraphrasing and generalization of what I heard. So I wouldn't even say this is exactly what any of them say, but it is a compilation of what I hear the top producers using as a 3-step process to move the prospect forward. Step number 1, you ask them, if you had a blank check to start or grow a business, how much would it be for? So now you got them stopping to think, well, that's pretty fun. That's like sitting back and pretending, well, if I won the lottery, what would I do with it? So, if I had a blank check to start or grow a business, well, you mentioned 100,000 a while ago, that would be fine. Or others will come up with bigger amounts. It doesn't matter. It's their dream. It's their vision. So, but you want them to start having visual imagery of, how much money would I like to have? Then you quickly follow up. Well, great. Let's just say they said 250,000. Well, great, Dion. If you had that 250,000, how would that help you? What difference would that make in your life? And again, it's like that visualization. Man, if I won the Mega Millions lottery, I'd pay off my bills, and I'd buy a new Bentley, whatever your dreams and aspirations might be. But the bottom line is you're getting them to verbalize how their life would be better, how their pain would be reduced if they had that blank check. Then, and this is key for our top producers, then they're going right in and moving to the call to action. And this is hugely important. So again, different people are saying different things, but here's the summation of what I heard them say is something to this extent. All right, April, with no risk, let's give it a try. All we need is your name, your email, and your phone number to get started. Fair enough? And then, of course, you need to get that into your landing page, and then that comes into us. What's going to happen then is we're going to send them the DocuSign. We'll copy you on the DocuSign, and the DocuSign will prompt them daily to sign it. And so it'll actually prompt them for 120 days. I've told some of you, well, I've told all of you that we're in the process of becoming less dependent on DocuSign, and we're going to have online terms and conditions here soon. We're continuing to work with the programmers on that. But at this point, let's just focus on the process that exists now. So before I get to the money for you, the second learning objective here, what questions, comments, concerns do any of you have about this simplified approach to pitching access to capital and then the 3-part scripting? So we've got some great minds on here. We've got April, Barry, Bernard, Billy, Bruce, Kwong, Dion, James, Jim, John, Joseph, Mark, Michael, Scott with 1 T, Scott 2 T's, Todd, Will, Desmond, Okay, so Michael's, and thank you. So what we're going to do is type in these questions, a Q&A into, it's like a chat box in Zoom, and we're going to flush through those, and then we'll get to the second learning objective, talking about your money. All right, Michael asked about the guarantee, and it's very important that they understand. Of course, it's in writing. Everything we do is in writing. As I mentioned, we're going to send them the DocuSign. Soon it'll be online terms and conditions, but we're going to send them the DocuSign as it. So the guarantee is clear, and it's in writing, and I'm just summarizing now. I'm not reading you the whole agreement that Karen, the attorney, wrote, but the guarantee is we will work with them to raise at least $100,000. We are on the hook. It's our burden, our contractual obligation to help them raise at least $100,000. That's why we can say that. Otherwise, that would not be very legitimate, right? If we didn't really promise to do that and really do that, then we couldn't say that. We'd get in trouble. Well, we're not in trouble because we do promise that. We promise that in writing, and we do that. So that is how it works. It's a $100,000 guarantee. And if they start peppering you with a lot of questions, Michael, what I'd say is, you know what? Those are some good questions. I really need to get the packet over to you. Packet, right? Packet. Don't say I'm going to get the agreement over to you. I'm going to get the packet over to you so you can review it and we can get started. Okay? And then, of course, by getting their name, email, and phone, you submit it, Michael, on their landing page. That triggers us to send them the DocuSign. Now they have it in writing. I don't know that you want to get too deep in interpreting the language of the agreement. I think our moral, legal, ethical obligation is to get anyone that's interested the packet so they can review it themselves. Because if all of a sudden, Michael, you play attorney and now you're reviewing it and interpreting it, and then you don't read it all to them or you don't interpret it all to them correctly, then what liability have you created for yourself? So what we want to do is create interest, have the call to action, you submit them in the landing page, and then they'll get the packet with all the details, all the details. Thank you, Michael. That's a very good question. All right, so Mark is getting good responses from his access to capital ads, very good. And so, but he's not always seeing conversions. And so that can happen. So you're casting a wide net. If you're submitting them in on the landing page and then we're sending out the DocuSign, then do they sign the DocuSign the first time they've received it, or does it take them a few times? Some of you are a little more sophisticated and you follow up with those that are not executing the DocuSign. Others, you're just working on creating a funnel. Again, when we move to the new platform that'll be less DocuSign dependent and online, you'll be getting more feedback and more, and we'll be able to move the clients forward more immediately. So good things are happening, I think, in March from that perspective. But you're right, not everyone will convert. And if you care enough to, then you can follow up with those that don't convert and see if you can problem solve. Remember, we do daily webinars for these prospects. And so that's where they can come and we can answer their questions and overcome their objections. You don't even have to. We've talked about those daily 10 a.m. Central webinars. But you're right, Mark, not everyone will convert. All right, so I think we're covered on the first bullet. If other questions, thoughts, comments come up, go ahead and throw them out. Now we're going to move to the second bullet. I'm going to make this a little bit larger and scroll down because this is really important that you know what's in it for you. All right, so there are 4 streams of income that come to you for doing this. 4 streams of income. So let's go through those and make sure that you understand. Any of us that have worked in a business development role, it's important to know your comp structure and how to work that comp structure to your benefit. Earlier in life, I was an internet director for a new car dealership. And so it's like, I need to make more money for my family. And so I studied that model. And it's like, wow, okay, so it's really based more about units of sale than it is trying to get the most profit out of each client. So I just became a unit whore. I would sell 30 vehicles at a time to cab companies, minivans, for example. So that really has very little relevance here. But the point is, you need to know the comp model, because if you know the comp model, then you can work it to your benefit. So let's go through the comp model. There's no changes here, by the way. We're just clarifying, just educating. All right, so what should be your first stream of income from access to capital is $1,250. Where did that come from? Because Tom, you said the client doesn't pay anything up front. How in the world did someone pay me $1,250? Well, that is 50% of the refundable deposit. With the access to capital, the client doesn't pay that up front. There was no upfront cost, right? We've said that, and that's the way it works. But instead, after they've gone through the second week of mentoring and you've helped them complete the personal financial statement and the soft credit pull, that along with the profile that we collected from their business at the time of enrollment, we know enough to guide them for their first tranche, first round of financing. And as long as they're qualifying for what we'll call a third-party source of financing, and that amount could be as little as $2,500 they get. It could be, we had a success story yesterday where it's $40,000. It could be a lot. But the bottom line is, as long as it's $2,500 or more, then of course, then that's going to go towards funding the refundable deposit, which they get back after they complete at least $100,000 capital raise. We split that 50-50 with you. And so you're earning $1,250 once the client has progressed through week 2. Now, if they are not strong enough to get any of the traditional sources of financing, and we have to go to our safety net, then we have a special lender, 0% interest, $2,500 loan that will extend to them, but it's a recourse loan. So in other words, we're on the hook because now we're dealing with really the highest risk of the highest risk people in the country. And so in that case, it's paid out as earned. So we're collecting the $100 payments from them. Each month we reconcile and we send 50% of that out to you. So you're still making 50% of the 2,500, but if they're super high risk and we can't get them financing through any of the traditional sources and we have to use a special safety net, you're still paid, but it's not accelerated. It's as earned, just because the risk of failure, a risk of them breaching the agreement is so incredibly high. These are people who've not been paying their bills for a long time. You and I are very optimistic to think that they'll keep paying us, but they say they will, so we give them the benefit of the doubt. So your first stream of income should be $1,250. That's triggered from week 2. Before they get to week 3 in the process, we should have typically receive that. It depends, because FTF, first tranche financing, can be a revolving installment. It can come in a number of different shapes. We have to match what the client's circumstances are. But certainly within the first 30 days, you should be seeing that, and ideally within the first 3 weeks. So there's the first of the 4 streams of income. And that you could even put a little asterisk there again, because if they can't qualify for any of the traditional sources and we have to use the safety net, you're still getting paid the $1,250, but it's as earned as they're paying it in, because it's recourse. We're at risk if they don't continue to pay. Now we're on to the second stream of income. And in my mind, this should be the most important one to you, because each of you should fall into one of 2 categories. You're either a licensed life insurance agent or you're working with one. Those are the 2 scenarios. You're either one or you should be working with one. I'm not here trying to encourage you to become one. I don't care if you become one. I'm not trying to recruit, nor do I recruit insurance agents. But I'm just saying this is a very important step that you need to be aware of. And I see many of you not leveraging this, which is insanity. That's why we're talking about it right now. So we know that a well-designed loan package has what? It has a business plan. It has financial projections. It has a key person policy. A what? A key person policy. So in week 3, of the loan package educational curriculum, we teach them about, well, what are collateral assignments? Why does the SBA require it? We even give them the link to the SOP, standard operating procedures, of the SBA, so it's validated. This is checking the box. A well-designed loan package should have a key person policy. You're absolutely crazy, maybe foolish, if either you're not writing these or you don't have someone on your team that's writing these. It's insanity. It's like being a waiter and not picking up the tip off the table after the client is gone. Okay, and what you also need to recognize, and again, I know that there's two very different groups on these Zooms. There's some of you that get it and some of you that don't understand it. And that's my fault, not your fault. Those that get it realize, oh, wow. So through this process, I'm going to get a bunch of entrepreneurs, whether they be pre-launch startup or existing, that want capital. From that, I'm going to be able to help them get their key person policy set up. Wow, that is freaking awesome. But what's even more incredible than that is now I know them and they know me. And I have a credible relationship with them, and I'm going to do a financial needs analysis with them and determine what other needs do they have that I might be able to fill. Do they have disability coverage? Do they have proper asset protection overall for themselves and their family and their loved ones? Do they have employees that have coverage? Are they saving for retirement? Is it growing without risk? All those elements that come from a financial needs analysis. This is not what we do. We're not recruiting insurance agents to go sell some product or program for us. This is a golden opportunity for those that are licensed insurance agents to be able to actively help more people. And again, this is not some recruitment to say, oh, you're not licensed, go get licensed. Man, that's the last thing I'm encouraging you to do. That may distract you from your primary activity, but you definitely need to have you want to have someone that you're working with that is licensed to write these damn policies. It's insanity to not do that. And I see some of you that don't seem to be doing that, and it doesn't make sense. It doesn't make sense. All right, I'm going to go through these 4 streams of income, and I'll get to your questions. Credit boost is the 4th stream of income, and this is if needed. Not everyone needs credit boost, which means we're helping them with no upfront cost, add new trade lines to increase their credit profile. And so you're going to make on average $500 from that. There's no magic to that. It's $5 a point for each point of credit score increase. I was talking to one of you who's not on the Zoom right now. Well, it's Brian. I'll just tell you, it's Brian. And so I was talking to Brian yesterday. Well, he has an excellent resource to help people remove inquiries, unrelated to us, has nothing to do with us. Great resource. And so what he's going to start doing, he's flipping the switch today, is, and he's one of the producers, 20 or more a week. What he's going to do is bring them into Credit Boost, then introduce them to this resource that can blast off inquiries. Well, what happens when you take inquiries off? Well, if you have excessive inquiries, especially, let's say 3 or more in the past 6 months, especially when you remove inquiries, that helps boost the credit score a little bit, not a whole lot. But let's say that added an extra 20 points to the credit profile. Well, he's making $5 per point, regardless of what variable changed, because we can't isolate what caused the credit score to go up. We're just simply working with them to improve their credit by adding positive trade lines. But certainly there could be tangent issues or variables that's also contributing to that. So he did the math. And he's like, well, man, I'll make on average an extra $100 from every client by bringing them into Credit Boost before I have them remove their inquiries. And again, he's going to be doing about 20 a week, so about 80 a month. That's an extra $8,000 a month just by him following that process. All right, so Credit Boost. And the nice thing about Credit Boost is when you bring a client in, as we've talked about, for access to capital, you don't need to pitch Credit Boost to them. automatically, when we get to week 2, we're going to do the soft credit pull. We'll look at their credit profile, and if they would benefit from that, we'll introduce them to that. They're not required to do it, of course. Most will if they need it, but you don't even need to have this conversation with them, right? It happens organically through the mentoring process and through the capital raise process. All right, so now we're to the fourth and final stream of income for you, and then we'll get to your Q&A. Performance fee. Obviously, we have 2 primary goals for access to capital. If we just cut to the chase, what are the 2 primary goals? Number 1, well, let's call it 3 goals. Let's go with 3 goals. Number 1, we want to help improve financial literacy of participants. And that's usually not the carrot that lures them in, but that is certainly a goal of ours, and it's consistent with our mission. We want to improve financial literacy. Second is we want to help them build a loan package. And so those are things like having the business plan and financial projections, having the key person policy in place, having those elements. So that's the second goal we have for access to capital clients. The third, of course, is we want to help them with a capital raise, of course, and that usually is the carrot. But it often takes improved financial literacy and the loan package to get the third. Because you'll have some people that just say, well, I don't want to become smarter. I don't want to build a package. I just want funding. Well, if you already knew enough and had enough to get funding, why are you talking to me instead of your banker? So usually they need the other 2. But the bottom line is the performance fee, you can anticipate at least $3,000. Well, where does that come from? Well, we're doing a 50-50 split of the performance fee. The normal performance fee is 6%. Well, half of 6% is 3%. 3% of the guaranteed $100,000 is how much? $3,000. As Joseph was asking, I think it was yesterday, and Joseph's on the call, but I think it was yesterday, it might have been just earlier this week. He was asking, can he increase the performance fee for his clients? And I don't know if Joseph's going to do that or not. That's up to him. But if Joseph wants to, he can go all the way up to an 80% performance fee. I'm not advocating for that. I'm not recommending it. Joseph runs his own shop. And if Joseph wants to charge an 80% performance fee, that's what Joseph gets to do. So that's not our norm. Our norm, of course, is 6%. But the bottom line is you can charge up to an 80% performance fee, and it's still 50-50 split. So what can we summarize from this? And we'll get to your questions. Well, you should make in the first month $1,250 and the policy sale. So you're around, let's just call it round off, call it $2,000 in the first month from each client. Even if they lack the credibility to get any of the traditional funding for the FTF, and we have to use the safety net, 0% interest guaranteed issue where it's paid out as earned. Even if that's the case, you're still selling an extra 20 to 50 policies a month. And at $1,000 a pop, that's 20 to 50,000. So that's why it's so important that you have someone on your team that can write those policies, because if you're missing out on that, you're missing out on a very important part of the front end income. Okay, so let me shrink this down a bit and let's dig into the questions that each of you have. John is asking, how are earnings paid? He says what he means is direct deposit as it comes. Oh, well, so depending upon if you're a joint venture partner, an educator, or an affiliate determines the payout sequence. But I can tell you that for payouts off of this, we throw all those contracts to the side and we want to pay you the next day. Once that money clears, we want to pay you. Because we know, John, we're not fools. We're not smart, but we're not fools. The sooner that we can pay you, John, your part of the refundable deposit, that just adds fuel to the fire. You get more excited, more engaged. And so normally we'll wire or Zelle or what have you, your portion of this almost live, almost real time. We need the client's payment to clear our bank, but we don't wait for the contractual payout periods. This here, you're getting paid directly. You know, you're not getting this money from us. You're getting it from the insurance company. So if you're writing like we usually do, Mutual of Omaha, they're doing, I believe it's still weekly direct deposits. Credit Boost pays out on a weekly basis, and performance fees pay out. It's either weekly or monthly. I forget how that's written. But the bottom line is the front end income that you can anticipate, you should be sitting on over $2,000 a client in the first month. And what's almost, what you can feel the most control of course, is this portion here. So you don't want to overlook it. All right. Dion asked a great question. So on the FTF, the first tranche, we're going to help them identify the right type of capital based upon their circumstance. And it could be a very significant amount. It could be 20,000, 30,000. The success story we had yesterday or the day before was 40,000. So of course it could be enough to cover their first year of premium for their policy. And that's why in week 2 we do FTF, and then in week 3 you're writing the policy, so you know what type of injection they've had. So you have, they typically have more working capital to cover that policy. Smart question, Dion. And so Jim's asking a good question. So yes, the key person policies can be written regardless if you're an affiliate or a joint venture partner. That is correct, Jim. All right, so Billy's asking for the key person policy, still what I have highlighted here. Well, so yeah, we have an arrangement with Mutual of Omaha, and if you all want to write it through Mutual of Omaha, it's guaranteed issue, non-med underwriting, approved typically in 3 days. You're welcome to do that. We can get you set up to do that, but it really doesn't matter to us. We're not trying to persuade you to do so. You and or your licensed agent or agents, and Billy, if I were you, to have a bunch of agents, because the more agents you have, they can be filling your funnel. But the point I'm trying to make is they can write it through whatever insurance relationship they have. You'll find great interest from Primerica agents, from WFG agents, from New York Life agents as 3 large entities, but it doesn't matter to us. You handle that part. That's not what we do. Thank you, Billy. And so Scott's asking a question similar to Jim. So that's correct. The key person policy can be written by the joint venture partner, the joint venture partner's team, or if you're just, as you are, Scott, an affiliate, and I don't mean that negative, but if you're just an affiliate, you're not in a leadership role, you can still be writing those policies for the clients that you generate. So that is, that's fine. And it's the same process. Thank you, Scott. Well, we're getting a question about FTF. So there's multiple different types of funding for clients, and that's true whether it be for the FTF or for Credit Boost. And we have to look at their circumstances to see what we believe that they qualify for. So you're right, different clients will be presented different funding strategies because not everyone qualifies for everything. All right, so Joseph asked about the high performance fee. Well, I understand, Joseph, and I'm not here promoting that you charge an 80% performance fee. You asked earlier this week, can you charge more than 6%? And we said, yep, Joseph, if you want to charge more than 6%, let us know what you want to charge your clients. We'll create a different DocuSign packet and we'll send that to your clients. We'll split it 50-50. I'm not suggesting that you increase it, not encouraging you to increase it. I'm just saying, if you want to, you asked the question and I said yes, and I'm just letting you know the maximum, we can't go above an 80% performance fee. But obviously you're adding to their cost of capital when you start jacking that up. Now, we also said you can reduce it, didn't I? in a prior training, I said, you can reduce this all the way down to 3% if you want and make it really affordable for the client. So yeah, I'm not here saying go gouge the clients. I'm just letting you know that you're in control. So it's your self-constraint that determines what you're charging them, not ours. On orphan clients, which really wasn't the topic today, but yes, if you're a joint venture partner, we have orphan clients. We put clients now in cohorts. We had a training about that. They start on Monday. So each weekend you'll be getting an allocation of orphan clients. We pay you $100 an hour to do the mentoring. Plus you can write the policy on them. And the pay is triggered off of when we get the FTF funding in. Thank you, Michael. Timothy asked, does the key person insurance work the same for sole proprietors as other types of entities? Yes, yeah. And is there a policy amount? Well, what you want to do is do a needs analysis, conduct a needs analysis with the client to find out what they're suitable for. And so you look at the current coverage they have and their needs and determine what gaps. But I guess, Timothy, what you're technically asking is from the purpose of the collateral assignment for the loan package, ideally they would have at least dollar for dollar coverage for each dollar they're seeking to borrow. So you ask them how much they want in their blank check. And so if they said, well, I want $500,000, then it wouldn't be a bad idea to get them a $500,000 policy. But you also need to reconcile other aspects to determine if they're suitable for that amount. And that's between you and the client. Thank you, Timothy. Timothy says yes. I'm not sure what the yes is. Billy says, you're welcome, Timothy. Billy says, if you have a licensed agent writing the key person policy that he or she is with. Oh, okay. Yeah. So for our joint venture partners, our model, and I think many of you know this, but it's good to restate it, and a couple of your questions leads to this. So we're doing a 50-50 of net revenue with our joint venture partners. So for example, does the client pay $2,500 for the refundable deposit? They do. And so how much is going out to you? 50%, half of that. Same, we do the same with the key person policy. We do the same with the credit boost. We do the same with the performance fee. So yeah, we're in this together. We're a team. It's a joint venture. And so we're doing a 50-50 split. Okay, so Scott's asking, to write the key man policy as an affiliate, do I circle back to them when they get notified that they've got the FTF? Well, that's true. So if you're a joint venture partner doing the mentoring, you're in an even better position to write the policies than if you're just an affiliate, but it technically works the same way on both. We know that when we get to the week 3 curriculum that we're going to teach them about collateral assignments and how that works. And so at that point, they've been educated. If you're already mentoring them, you already have a knowing, trusting, active relationship with them. If you're just the affiliate, it'll be a little less natural. But the bottom line is you can start that conversation in week 1 or week 2. Certainly we're emphasizing it in week 3 because it's part of the curriculum, but it's never too soon to start preparing them for that. If you wanted to wait until after their FTF, you could do that, or not. It's really up to you. We're stepping back and not micromanaging that portion. So it's up to you. You know the 4-week curriculum. You know in week 3 we're going to be talking about collateral assignments. You know that we're looking for a key person policy to be uploaded into their Dropbox as part of the loan package. And it's really up to your cleverness and creativity and preferences of when and how you're going to pitch that. Great question, Scott. Okay, so I'm going to do a quick summary, and then anyone else that has any questions, comments, or concerns, go ahead and get it in before we wrap it up today. So today's Friday, December 19th. We're off to an awesome month. Awesome month. We're making some significant changes operationally to better facilitate the growth. We're going to move away from being DocuSign dependent, allowing people to accept terms and conditions online with better tracking, better feedback for you. So that's all in process. Regardless of that, we want to turn the throttle to high. Right? Some of you are kind of at an idle or a cruise control. We would encourage you to push the pedal down a little bit harder. We've talked about what some of our top producers are using as talking points, and then some recommended scripting for the access to capital. And then we've gone through it and re-emphasized the 4 streams of income that can benefit you. Okay, so let's wrap it up with any remaining questions, and then we'll get to work. Billy's asking a question which shows my failure, because Billy's asking, how much does the insurance agent get paid to write the key person policy? And the answer is, I don't know, because we don't dictate that, right? The insurance agent is writing a policy through some insurance carrier, and that insurance agent has agreed to some sort of contractual rate for the policies they sell. And so the insurance agent knows how much they get paid. And if you ask the insurance agent, they'll know, or they can find out. But I don't know how much every insurance agent everywhere makes. It can vary. But on average, they'll make usually around $2,000 a policy. And so if we're doing a 50-50 split, that's where the 1,000 comes in. All right. Well, hopefully this was productive, eye-opening, and it just simply takes a minimal level of competence to get out there and run Facebook ads or run Craigslist ads or whatever your magic sauce is. Create awareness, use these 4 key bullet points, consider using this recommended scripting, say as little as necessary, do as little as necessary to create awareness and get them into your landing page. And then the system will take it from there. All right. Thanks, everyone. Have a great day, and we'll talk to you soon. Bye-bye.